Hello, my name is Brian Overby. I am the author of The Options Playbook, and welcome to Options Guy TV. We've had a busy week on Options Guy TV. We tape every Monday, Wednesday, and Friday at 11 a.m. So this week, we're going to go back and look at a few of the trades that we did over the week, some of the paper trades. One of them was in Walmart, and Walmart had their earnings. It was a little bit of an interesting trade. We'll take a short peek at that because it didn't turn out too well, but that's all right. We had it set up. We had very little risk when we put on that trade. But I really want to go back and revisit what has happened in the banks. And in particular, back on July 31st, we looked at a fig leaf in a company, little known company called Charles Schwab. And it was riding into a volatile period. And I think a lot of what's going on in the markets right now has a lot to do with seasonality. And it was really funny because we actually highlighted a chart, which I'm going to do a little foreshadowing here because we're going to talk about this next week and maybe even do a trade in the VIX, which we've never done so far on Options Guy TV. But we highlighted a chart that I will bring up on Monday again, and that showed as from August all the way out until the end of October, over many years, over about 20 years in time, we've seen the VIX in general spike up, and all the lows and volatility usually happen in July. And interesting enough, on August 1st, we had the downgrading of the U.S. debt by a rating agency. And the markets got volatile. And guess what? They've stayed volatile. And if we look at the VIX right now, we're showing the VIX is actually at around 18%. So at the end of July, we were down around 12, 13%, like in the doldrums. Actually, I don't like trading options as much. Once we get down towards that 10% level on the VIX, I'm always going to have some position on I'm going to trade it, but I'd much rather see the VIX around the 14, 15 level than as opposed to all the way down towards the, breaching that 10 level. If it gets below 10, it's in my mind, it can't go any lower. That's the lowest point where the VIX really is at. That means you're talking about the premium in the S&P 500 index to try to hedge a portfolio. So it's really hard to break. It has broken down below 10 over the years, but it's very hard for it to do. Okay. So why is this happening in the banks? And a lot of it has to do with the yield that we're seeing, the yield curve. We're between the 10 and the 2. Now, the yield is coming in. The yield curve is right now, it's about 0.64%, the difference between the 10-year, the long-term interest rate, and the 2-year, the short-term interest rate. It's been as wide as $1.50 since we've had this downturn, I guess, in the economy, or recession concerns would be a better way to say it. Another way would be that since the Fed has started hiking interest rates, but that's a good thing. And in general, that would make the banks usually go up in value. They want to be able to take money and pay out those monies at a lower interest rate, hence the short-term rate, and then sell mortgages, et cetera, at a higher interest rate. So that's the general way that a bank makes money. So when you see that spread come in, that's usually a good thing for most of the financials. Now, what has happened, though, is it's coming in an odd way. We're seeing the 10-year spike up in yields, which that overall does hurt on the bank scenario. And we're seeing the 10-year or the 2-year actually kind of stay steady, and that's what's decreased the yield curve. Okay, so there's a mouthful there, but ideally, in a real strong economy, what we would like to see is that the 10-year yield starts to come in line with the 2-year yield, but they both come down. And hence, the 10-year kind of stays where it's at. The 2-year actually comes down faster than the 10, and then we see the yield curve kind of come back in line. Well, that's not happening. And so a lot of people are talking about treasuries. That's been the main topic of all the pundits. And the people that are actually really getting hurt for it are the banks. And we've seen really good valuations in the bank. Even Charles Schwab is trading right around a 17 PE. So they've been beat up, and they actually, since the news of the regional bank failures, if you will, we've had a strong move up in the strong banks, in the big banks. They've done well, and some of the regionals are peeking their nose out from under the water too, and they're done fairly well. But now we're already giving that back, and a lot of that could be a little bit with the seasonality. But I think the biggest thing is we'd really like to see the 10-year yield start to come off a little bit more, get that yield curve even a little bit more tighter, and have the scenario that we were talking about. So if you are interested long term, yeah, you could even look at some of the financials, the XLF, which is a banking ETF, and just think about buying something in the financial area if you're a long-term investor and you think that the yield curve will eventually come back in line, and you'll see the 10-year trade at a higher interest rate than the 2-year. All right. So let's go to the TradeHawk software and let's look at our Schwab position. Now, I know we did a trade on Walmart and it was an earnings trade. Not much has happened there. And we'll talk more about that. But I got Schwab in my head, and on July 31st, we looked at putting on a long call option in Charles Schwab. And we went deep in the money, and we went out into the new year. We didn't sell a call at that time, because a lot of times if I'm going to use a option as a surrogate for the stock, I'd like to see a little bit more of a run up on the stock. And the chart was a little sketchy, and we did mention that on the Options Guy TV show we did on the 31st of July. But I have the Charles Schwab graph up right now, and this is the area that we were talking about. We actually had a break up above the 200-day moving average just for a second, and I would call this a breakout and failure. There is just a lot going on right in this section of the chart. We see here's a gap up, or I should say a gap down, and then another gap down, 2 days in a row, two big gaps down. We filled a gap here, like look right here where this gap is at. We filled this to get all the way back up, and that was, as far as the Fibonacci retracement is concerned, that was a right at the 50% retracement line from this point all the way down to this point. And so we really wanted to see if we were going to break out in this range. And guess what? The stock just didn't do it. So I think it's time to revisit it, because now we've came all the way down. We've broken through the this is the 20-day moving average, came down all the way down to the 50-day moving average on it. And we do have a hard stop on deep in the money calls. We usually start by looking at least an 80 delta when we're buying a deep in the money call, because we're buying this as a surrogate for the stock. That means that the option contract is going to be definitely more expensive than an at the money option contract, more than most people that are speculating on the market want to pay. But we're looking at this as a more of a longer term investment, even though our expiration was January of 2023. It still is a longer term in the options world, a little bit. So with that said, if I go deep in the money, I'm going to pay for the intrinsic value. I'm going to get a lot of reaction to the stock price. The stock goes up one, my option contract would go up about 80 cents, or the stock goes down one, my option contract would go down about 80 cents. So the concept would be that if I was going to buy 100 shares of Schwab, I'm going to buy this option as a surrogate for the stock, and I'm going to limit my risk, and I'll have a limited and known risk. My risk in this situation would be the premium that I paid for it. And like we mentioned, the markets were a little scary going into September and October. So let's see what happened with our trade. So I'm going to go back to the trading page in the options grid inside the TradeHawk software here. So when we put this trade on, the stock was at 64.65, right where that grouping was, where Schwab really wanted to break out underlying stock. At least we really wanted it to. Let's say we wanted it to as a a paper trade here on Options Guy TV, and it just couldn't get that momentum, and it just didn't break out to the upside. So we're down 10% on the stock. So if you had bought the stock and you bought 100 shares of stock, you would have lost 10% because we're now trading at $60 a share. It was, well, a little less than 10%. It was around 65 when we put on the trade, and so let's call it $5 we lost. That's $500. On our option contract, we've lost close to that, a little less, but when we put the trade on, we were trading at 1540. We did the the January 19th, 154 days now left, but 154-day option contract. That's what's left. We put it on in July, so there was more time when we put it on. But January 19th, and we did that for a reason. A lot of times if I'm buying longer term options, I'm going to buy that January month in the next year, right? And I could even go out longer in this. I wouldn't mind that. One of the things, I try to keep things on a paper trading level here on Options Guy TV at a reasonable price. So it was $1,540 to control 100 shares of Charles Schwab and buy something that acts a little bit like the stock. The delta was right around 80 when we put on that trade. That means that if the stock went up 1, we'd expect our option contract to go up by 80 cents. Another way to say that is if we're doing it apples to apples, right? One contract versus 100 shares. If the stock went up 1, you would make $100. If the stock went up 1 and you own the option, you would make $80. And it's dynamic. It's not always a perfect thing. That's always in theory. And that's what delta will give you a realistic expectation of the stock price movement. Okay. So on Options Guy TV, since we launched, we've said, well, on the trades where we're actually losing money, there's sometimes make more interesting shows, right? Because a lot of people know what to do when you're making money on a trade. But what do we do now? Because we've truly had a loss in this. The stock down 10% on a stock like Charles Schwab trading at 17 times earnings. That's a big move. It's a big move to the downside. That's simple. So this option contract that we bought, I'm going to just highlight it here with my mouse, and I'm pointing to it, is right at 52.50. So we paid $15.40 or $1,540 plus any commissions that we might have paid. And now we're trading at $10.30. So kind of want to highlight, first of all, that, yeah, we got similar stock price movement, right? On the downside, we lost about 500 some odd dollars in the stock, and we're losing about 400 some odd dollars in the option. So we did have a lot of stock price representation on the downside. So the first thing I want to point out, though, is now that we've made a little bit of a move down towards the strike, the first thing I highlight here is that the delta is now going down. The delta, and I'm pointing to it on my option grid here, is at 73. That means if the stock goes down another point, our option contract will lose 73 cents as opposed to 80 cents. And this is an interesting dynamic, is that if I am wrong and I buy this deep in the money option, as the market goes against me, I lose money slower. I'm losing money, but I'm losing it slower because the delta becomes smaller. And hence the reason why when we do an option trade like this, this will always be the case up until it gets all the way down to our strike price. So whenever I buy a deep in the money option contract, if the stock reaches my strike, I'm going to get out. Why is that? Because I'm selling the most juice, the most time premium. It's simple to say that if it comes down, that's obviously a pretty big move. It's down 10% and hasn't reached that yet. But if I look at the at-the-money option contract and say this second, boom, that stock went to 52.50, that's going to be trading for right around $5.50. If I'm highlighting the bid here, like the at-the-money option contract, which stock is at 60. So this is a little quick and dirty way of saying, okay, the stock reached this level, how much would I be down on the trade? Well, if it got down to there and it happened right away, right? So this is taking volatility, all this other, well, it should be trading for what the at the money is trading for right now. So let's think about that. And I'm going to pause for a second. If I put this on and I look at the change right now and I see the at the money option contract is trading for $5.50, if this becomes the at the money option contract, well, I would expect that to trade for about where the most at the money contract at the money contract is trading for right now. So $5.50. I'd want to take advantage of the premium that it's at the money, and I would get out of the trade. I wouldn't even hesitate. I don't care where we were at. Well, I mean, if we were right at expiration, we still got a lot of days left, 154 days, but I would just get out of the trade. The market obviously doesn't like what's going on. The stock has came down to a certain level. We see it in the charts. I don't really like the way the chart looks anymore. We didn't get the breakout. I would just get out of the trade. Okay. So if I was doing the longer term option in Schwab, I would literally consider going out a couple years in time, and then that would adjust my trade, but I'm still going to get out when it would reach that strike. So what could we do to hedge this? And that's what I think that's the value of Options Guy TV, is to say, okay, this trade has gone against me. What can I do? Well, I've already lost a good portion of my investment, very similar to if I had bought the stock. And if I'd owned the stock and I wasn't a long-term investor on Charles Schwab, I would probably get out down around 10%. The William J. O'Neill, to almost date myself from way back when, would always say never lose more than 7 or 8% on a stock. And those were the magic numbers. Well, this is down around 9%, and between 9 and 10%, I would just get out. Okay. What can we do with the options? So here's my trade. So now note, I'm jumping from this expiration, the January 19th expiration, and I'm going to look at the September 15th expiration. Why am I picking the middle of September? September's a volatile month. I want to give myself some time. And what I'm going to do is I'm going to collar this position. And a lot of people would be like, well, why didn't we sell a call to start with? And that would have turned out just fine. But I don't usually do that. I was looking for a breakout, and I didn't want it to be pegged on my strike and have to do something with my longer term option. A lot of times I like to wait a little bit before I sell that call. So now we're going to do it, but I'm more worried about the downside. If I didn't sell it and get out, I would consider putting on this collar to try to help myself. Okay. So, and I want to do it now. Because I still can get something for this 65 strike call. And I'm looking to sell the 65 strike call to help pay for my protection. September 15th expiration, 28 days away, right in the middle of September. I like the fact that I went a little bit further in time because we are in September and October. We talked about the seasonality of the marketplace, and I'm doing a collar. So I don't mind going out a little further in time because I'm going to buy a put for protection, and I'm going to sell a call to pay for that put that I'm buying for protection. So now realize we have a position on. We are long one option contract that expires on January 19th of 2024. So our trade that we would enter on our position is we would sell the 65 strike call. Note that it's trading at a 36 bid, which these real tight markets, we got penny markets in Charles Schwab. And then we would use that to buy the 5250 strike call. And that's trading for 26 or 27 cents right now. So I'm selling that point that we struggled to get through on Charles Schwab on the graph, taking the proceeds, and I'm going to protect myself on the downside here on the 5250. So on the 5250. And this is the way that my trade is going to look. Now, I see that we have a question, and I'm going to address it here in just a second. But let me go in and just finish my thought on this trade. So if I do this, we now are saying, well, if it gets up to 65 by that September 28th expiration, well, I'm going to have to do something, right? Because I got this short call option. I don't own the stock. I own something that allows me to buy the stock, but I don't own the stock. And that's a very important level. And I want to know when it gets to 65. And I'm going to keep a close eye on that because I'm probably going to adjust that trade. On the downside at 52.50, I'm also thinking that, well, if the market comes down, let's apply our little rule. Like if it did come down to 52.50, would be trading for what the at the money is trading at right now, right? So if we had a big move to the downside, another 10% move, right now this at the money option contract, 59.77 is where it's at. It's trading for, let's call it $2. So if it comes down to there, I could expect to at least get $2 on my option that I didn't pay for, right? And I would once again sell that, sell the long option, use that $2 to help pay for my option contract. And that's the concept. That's what I do. It's that simple. I'm just going to put this on. Now I feel kind of comfortable. I don't really like where the chart is at, but it allows me to stay long on the position. I'm still going to have some risk. If it goes down to 52.50, I'm still sad that I didn't sell right now, but I have a little bit of protection going out for the next 28 days on this underlying stock. And here's the order. We're going to enter this. Remember, we're long this position in our account. We're going to sell to open the September 15th 65 strike call. At the same time, buy to open the September 15th 52.50 put. And we're going to do this for a net credit right now, and we'll hit that midpoint of 10 cents to the account. So we're bringing in 10 cents, which is nice. Our protection is bringing in a credit to help offset any commissions I may have or whatever. And it's just a solid way to do the trade. Now, let me address this question, and I'm going to come back and I'm going to show you something. This is a way that I would look at it, in the way that I will talk about it with novice investors. I would probably do something a little bit different if it was my own account. Not saying that there any one is better. It's all about, a lot of people don't like to pay for insurance. They like to try to get free insurance in the options trading world. So I'll look at that adjustment, but let's see what comments we have. And if you have any comments, please do put them in the chat box. Let's go out, put them in the chat box. I will try to address them during the show or even at the very end of the show. But we want to make this as interactive as possible. You know, the platform supports this, so we want it to be a very interactive show if we can. Okay, so here's my question, and we see it up on the screen. A fig leaf trade. If it drops in price, would you manage the long call by rolling it forward in time until it gets a chance to recover while collecting premium by selling calls against it? Okay, so that, to me, that's a selling call situation, right? If it comes down, would I roll my option forward? I don't think I would roll it forward. I have a rule in place. I'm out 154 days still remaining to expiration. If it comes down to my strike, like I said, like our rule, and that, I'm just going to get out of the trade. It's down enough. I've driven the car off the cliff. I'm not going to take it to the auto mechanic place and say, here, fix it, right? I'm done. I'm moving on. The market didn't see things the way I did. And because of that, I'm just going to get out of the trade. But I would adjust my call option. So if I had sold that call option, that option probably would have expired. It would have helped me out quite a bit on this trade. And I would look to do another call option. And I would sell enough call options. If it got all the way down, I like the concept of selling the call option. And this is part of the reason why I chose this to be our topic today. I'm selling that 65 strike call, which is where the stock was when we put this trade on. And I like to be able to do that. I'd like to be able to sell something about where the stock is when we put it on. Because if not, then you're really dancing. If the stock comes all the way down, and let's say it's down towards the 52.50 level, and now I got to sell the 57.50s to make everything work. Now I'm kind of pegging myself, right? Because there's no way I will get to, if I fall asleep and that stock skyrockets through that strike price, there's no way that I'm going to be able to be profitable on my long call option. So I definitely want to keep selling calls against the position. I have no problem with that. If it gets to a point where it's getting low enough, you know, I'm going to be more apt to just sell out the long call position and not sell any more calls against it. Say, I don't want the cheese anymore. Just let me out of the trap. It's one of my favorite option statements that I like to make when you're getting in trouble. So I don't mind where Schwab is at. I don't like the seasonality of the market, and I don't really like where the chart is at. So I wouldn't mind just selling out of the position. If I don't sell out of the position, I'm going to look at this collar, which is on 100 shares of stock. This is how you would collar the position. So and if I even look at the what if portion of our of the TradeHawk software, you see that between the strikes, 65 on the call and 52.50 on the put, it doesn't really cost us much. It helps us if it continues to go on down, and it on the way up, it will cap our upside. But this is the position that we put on around the call option that we own. All right. All right. Any other questions that we might have on this? And I spent a lot of time on this. So let's quickly look at what happened on Walmart. But I really thought this was a great chance to learn. The stock has really came off, and for all the reasons that we mentioned. So let's run back. Now, this was annoying with Walmart. So we went and we looked at Walmart. Walmart, to go back to my notes and look at what the expected move, it was about a 3.5% expected move, around $5.75. They came out, had a real good earnings report, and it was, the situation where you're going to sell the news. They had a better earnings report than Target did. But Target did say that they were profitable. They had cut some costs. They were their retail customer wasn't doing as well, and their sales did drop and all that stuff. But they had managed profitability, and Target stock went up. But guess what? Target was beat up going into earnings. Walmart is the exact opposite of beat up. It's reaching a new high recently, and that stock sold off. And here's what was really annoying about it, is that Walmart went down on their earnings report and Target went back up higher. So they took the Walmart good report, and the marketplace decided that this report was so good that it should lift Target higher, even though we're going to take some money off the table on Walmart. And that was fine. We went out and we did, I told you that on Wednesday that I struggled a little bit trying to find the right strategy. And we did a zero cost skip strike butterfly. So when we put on that trade, we were hoping for that move to the upside. If we would have got the 3-point move to the upside instead of the downside, this would have been a real good trade. We put it on for a net debit to the account of 5 cents. And here, let me grab the trade real quick. And if you have any questions on this trade or even anything we talked about on the Fig Leaf, feel free to let me know about it. And if I look at the Walmart trade here, 1 second. What we did is we bought the 165 call. So we're seeing some strength in Walmart today. As a matter of fact, it was even up a little higher. So we went out and had the nearest term expiration. It was a very speculative trade because we were using extremely short date options. And we bought the 165 call, sold 2 of the 167.50s. We skipped, hence the name skip strike, the 170s and bought the 172.50s. We added some margin to the account because we didn't do a standard butterfly. So there was additional risk if this market came all the way up to 172.50. So there was a $2.50 margin requirement if we put on that trade. But we really wanted the stock to go from, it was trading at 159.20 when we were on the show, and we wanted it to make that 5-point move that we were talking about up to 165. We had 2 days to do it. This is going to expire worthless. We paid 5 cents for it. We looked at it as a comparison to doing a short call spread to kind of be bearish on it. And we would have made 33 cents on the short call spread. The short call spread, in hindsight, would have been a better scenario. Actually, and I even considered it before the trade went in. An iron condor would have been ideal if you would have sold the short put spread and the short call spread. But take the trade. We managed it. We set it up right. We paid 5 cents for it. Oh, well, it didn't go up. It went down 3 points as opposed to up 3 points, and the trade just didn't work out. All right. So it's right at time. Do we have any other questions? And I also want to mention USO is bouncing back. That was one of the other trades that we did, and it's still just a watch for me. Let's see. Recently, we've seen a little bit of a bounce back on the charts. Let's slow this down a little bit. Let's go like 90 days. 90 days on our chart. And we'll see that we did come down a little bit. We got down closer to the 70 level, and now we've had a strong bounce back up to the 72.45 level. We want it to obviously get up to right around the 75, 76 level. That would be the ideal next stopping point. So just stay the course on it. No other questions that I see here. That's it for this episode of Options Guy TV. I am foreshadowing on Monday. I'm going to look at a VIX trade. The VIX is one of the most odd underlyings to trade. It's almost like trying to trade options on the weather. Like, whereas I'm here in sunny Charlotte, North Carolina, it's been 90 degrees all week long. Is it going to continue to be 90 degrees next week? Or are we going to finally see a little bit of the fall weather coming in? That's where volatility is. You never really know exactly where vol is going. And we're going to take the chart that we discussed at the end of July, look at that, and we're going to try to come up with an interesting trade in the VIX on Monday. So that's it for this episode of Options Guy TV. Please click subscribe, ring that bell, pound that thumbs up. It helps us out here. And we'll see you on the next edition this Monday at 11 a.m. Eastern Time of Options Guy TV. Thanks for coming, everyone.